Markets picked up speed in the second half of the year. Strong earnings, resilient growth, and rising confidence turned a fragile start into a solid upswing. That momentum has carried us into what we can call an Indian summer, or central scenario for 2026, with two alternative roads: overheating, meaning inflation flares up again, or a freeze, meaning recession risk returns. I'm Charles-Raymond Chaud, and these are our top 10 convictions for the year ahead. We expect global economic growth to strengthen in 2026, driven by a renewed global capex cycle, monetary policies that are still supportive, ongoing fiscal support across the US, Europe and China, and a temporary easing in trade tensions. Inflation should remain warm but manageable. The world is moving away from the globalized, efficiency-driven model of the past. National interests and strategic rivalry are taking center stage, with the US-China competition leading the way. AI, defense, and electric power are the new battlegrounds, driving reshoring, tighter alliances, and control over key commodities. The results? Higher debts, ongoing monetary support, persistent inflation, and elevated bond yields making real assets more important than ever. The secular AI bull market is far from over. It is a multi-year, multi-sector growth engine. AI infrastructure investment triggers broad-based multiplier effects across construction, utilities, heavy industry, transportation, and urban developments. This wave of spending extends well beyond technology alone. We expect US market leadership to widen beyond technology and communication services. Investors should avoid excessive concentration in a single theme, and instead expand exposure to sectors poised to benefit from rising productivity and a global growth reacceleration. Industrials, consumer discretionary, healthcare, and mid-caps among them. International and emerging markets are regaining momentum, helped by a softer US dollar. Valuations remain attractive, and emerging markets often outperform during Fed easing, offering strong exposure to global tech. International diversification is essential. Although the dollar has stabilized recently, it remains subject to fiscal and political uncertainty and the Fed's rate-cutting path. We continue to view the Swiss franc as the strongest fiat currency. AI infrastructure build-outs, rising electricity needs, and increasing defense spending are boosting demand for industrial and precious metals, as well as critical minerals such as uranium and rare earth. Correlations between G7 government bonds and equities remain elevated. A renewed rise in G7 yields could even trigger the next market correction. The 10-year US Treasury yield remains a key indicator to watch. Investing in bonds and companies outside the G7 can boost income while spreading risk across your portfolio. Hedge funds, private debts, and infrastructure remain attractive, helping portfolios enhance returns while managing risk. With these convictions in mind, we are ready to navigate 2026 with confidence, opportunity, and a focus on long-term growth. On behalf of Swiss Bank and the entire investment team, we wish you a wonderful year ahead in 2026.